was because there were so many satisfied clients that the company grew.
This man presented himself as a seasoned investment manager, while orchestrating one of the most sophisticated scams the world has ever seen, swindling hundreds of people of their money. His sales pitch was simple yet enticing. He claimed to have invented a groundbreaking stock trading computer program that is capable of delivering an incredible 20% monthly return. It was an offer that sounded too good to resist for those who heard about it. Besides, who wouldn't jump at an opportunity that could turn a modest investment into a small fortune within a short period? According to him, the software would help investors identify rising stock prices ahead of the market. He even showed evidence of how he could turn stocks for some high profits, including the success stories of early investors. To further instill confidence in the authenticity of the money-making software, the investment guru started with his inner circle, his family members and close friends who trusted him implicitly, by offering them exclusive access to what seemed like a rare investment opportunity. Though only for 5 years, this man was able to deceive other eager investors who also followed suit. As word of mouth and tales of extraordinary profits circulated, investors far and wide lined up to give him their money. So what started as a small-scale operation quickly snowballed into a multi-million-dollar scheme, with over 300 investors collectively pouring $17 million into the investment manager's coffers. A particular soldier from Iowa invested a $5,000 re-enlistment bonus. Some others maxed out credit cards, mortgaged their homes several times, or withdrew from IRA accounts to obtain the purported 20% return. Ordinarily, one should know that such a huge return couldn't exist without some significant risks. This man preyed on the unrealistic expectations of the innocent investors to swindle them out of their money. The high sky returns were all scams, and the purported software was a Ponzi scheme. As many now know, a Ponzi scheme is a fraudulent investing scam that promises high returns with little to no risk to investors. It operates on the principle of using funds from new investors to pay returns to earlier investors, creating the illusion of profitability. Consider it similar to a pyramid scheme in structure. Eventually, investors lost a total of $17 million. Lives were shattered, hopes were dashed, futures were destroyed. And finally, the investment manager's scheme crumbled under the weight of its own deception. So, who was this man who perpetuated the multi-million-dollar Ponzi scheme that left a lot of investors in financial ruin? And how was he able to achieve it? Let's dive in real quick. Firstly, we will take a closer look at the man behind the scheme and the events that set the stage for him to successfully carry out his elaborate, deceitful scheme. The story started in a modest home in Elk Grove Village, Illinois, located just 20 miles south of Chicago. It was here the man, whose name would soon be synonymous with deceit and betrayal, lived before moving to Prospect Heights, Illinois. At the time he started the scheme, he was sitting on debt from his last failed business, which was a storage company. With no prior business expertise, he decided to establish a stock investment firm. It's not the case that he employed an investment expert to manage the firm, rather he took the job upon himself. One wouldn't think too much before one realizes that he was on the path to tricking other people for their money. Beginning in approximately 2005, the man in question embarked on a campaign of promises, the same way politicians reel out a long list of promises during campaigns and rallies. In this case, it's the promise of wealth and financial prosperity that seemed too good to be true, at least for a deep-thinking individual. With offers of a staggering 15 to 20% returns on investment per month, he painted a picture of financial success, assuring them of his capacity to turn an investment, no matter how modest it is, into a small fortune in no time. But he thought the allure of astronomical returns might not be enough of a trap, so he went further to sweeten the deal by offering to cover the pesky capital gains tax so investors could get a reasonable sum after taking his share. The added offer was a cunning strategy to get rid of any potential barriers to entry and make the investment opportunity more irresistible. What a smart, or better still, cunning move. And if that wasn't enticing enough, there were additional returns on the table. Those who were able to bring new investors to the scheme would get additional returns dubbed commissions. These additional returns promised higher returns than the already impressive 20% monthly yield. It was the perfect icing on the cake, an attractive incentive that was aimed to further make investors committed to the scheme. The mastermind of the investment went on to make several sales pitches for investors who might be interested in the investment scheme, boasting financial expertise that hadn't been possessed by anyone before. But beneath the grand promises lay a sense of doubt. Some curious investors began to be skeptical about the scheme. Is it really possible to get such incredible returns month after month without fail? Or were the promises nothing more than a carefully planned scheme to trap unsuspecting investors in a web of deceit? They quizzed. When pressed for an explanation about the mechanics behind his seemingly miraculous investment scheme, the mastermind gave an opaque response, obviously evading the question. Then he spun different tales. To some investors, he told a tale of innovation and ingenuity, claiming to have developed an investment plan from scratch alongside his brother. That could have been an impressive feat by any measure if true. But that wasn't all. For others, he told an entirely different tale. This time around, it is that of technical prowess. He claimed to have purchased software designed for penny stocks, then skillfully modified it to suit his needs. The second narrative appealed to some investors, especially the tech-savvy ones. After all, there have been cases of tech geeks who leveraged cutting-edge technology for financial gain, so the mastermind's case might not be an exception. By giving divergent explanations, the investment manager left investors to choose the options that best aligned with their thoughts and expectations. But, underneath the elaborate tales, there was more to the scheme than the mastermind was letting out. Unbothered by whatever potential investors perceived about him and his purported investment, he boldly presented himself as a scalper. A scalper is a trader who stays in a stock position for a maximum of 15 minutes, and always places their orders on a stop-loss basis to minimize risk and maximize returns. Scalpers rely on lightning-fast decisions, and the mastermind carefully prided himself as one to further reinforce how his investments promise short-term returns. Remember, the scheme was centered on short-term investments. But what could be the secret weapon behind how he was able to deliver the promised profits with unwavering certainty? He finally attributed the secret to the incredibly sophisticated software he purportedly invented with his brother. That's the technological marvel that gave them an advantage in the world of stock trading. The software, he claimed, had the power to predict stock price fluctuations before they even happened. That's a case of peeping into the future to know exactly how a given stock was going to move a few minutes before it actually happened. No small thanks to his trusty computer system. Things began to get more interesting as the mastermind claimed to follow the remarkable predictive tool consistently. Once the software indicated that a given stock would make a specific move, he would swiftly execute his trades, selling the stock at precisely the right moment to maximize his returns. According to him, it was a strategy that yielded consistently profitable returns, with his investments always reaping the rewards of his timely actions. He also asserted that he never held onto stocks overnight. Instead, he made it a point of duty to sell them by the end of each trading day. It was a precautionary measure that he believed safeguarded his investments against potential market fluctuations. And with a safety net firmly in place, he boldly declared that he had never suffered a loss on any transaction, regardless of whether the market trended upward or downward. But that's not all about his investment strategy. He also added that investors could repeat the process he used multiple times throughout the day, so they could reap multiple returns in quick succession. After all, he claimed to have benefited from the same strategy on numerous occasions. But could the mastermind truly predict the unpredictable nature of the stock market with such pinpoint accuracy? The more we get into the details of this elaborate scheme, the closer we get to the truth. Initially, the mastermind operated the investment scheme from the comfort of his home. If nothing, the internet has made the global world a small space. The irony, however, is that he never looked for investors. Rather, they came looking for him, after they were drawn by the allure of his purportedly revolutionary software system. Through word of mouth, the reputation of his cutting-edge technology spread like wildfire, attracting a steady stream of investors who were eager to cash in on the promised riches. However, by the spring of 2008, the mastermind found himself overwhelmed by the constant influx of visitors to his home, all clamoring to invest their hard-earned money. The once quiet residence soon became a hive of activity, with people arriving at all hours, their pockets brimming with cash. It was a situation that the mastermind could no longer cope with, prompting him to seek out a more suitable location for his booming enterprise. And so the search for a larger space began. He needed a space that could accommodate the expanding operations of the scheme, as well as provide potential investors with an appearance of legitimacy. Eventually, he settled on a nondescript office located at 60 Turner Avenue, Elk Grove Village, 6007. It was here, within the confines of this unassuming building, that his operations took on a new guise with the promise of financial prosperity and wealth creation. Stepping inside the office, you'd be forgiven thinking you'd probably stumbled upon the hub of a legitimate investment firm. the investment guru sitting in front of rows of computers, buzzing continuously with real-time updates on stock prices, charts, and market trends. The sight of such a setting lent an air of credibility to the mastermind's claims. To the untrained eye, it appeared as though he was a seasoned investor, skillfully navigating the complexities of the stock market with ease. But it's all part of the game to lure unsuspecting investors into the scheme. Every keystroke, every click of the mouse, was aimed at creating the illusion of financial prosperity. Despite outward appearances, the reality of the operations of the scheme was far less glamorous. While he may have projected an image of success, with him trading up to $200,000 at a time, the truth was that he was losing money at an alarming rate, up to $500,000 a year in failed investments. That's a stark contrast to the lofty promises of high returns and financial security that he peddled to his trusting investors. Where was the magical predictive tool he claimed to have invented? He didn't stop at that. He went further to solidify the illusion of prosperity by concealing the true nature of his fraudulent scheme. One tactic he employed involved the creation of bogus and poorly crafted monthly statements. The statements provided investors with a comprehensive overview of their investments, their deposits, and withdrawals, as well as monthly earnings and account balances. At first glance, these account statements he crafted on his computer appeared to validate the mastermind's claims of consistently delivering returns of at least 20% on investments. It turned out that the mastermind was operating a Ponzi scheme in its purest form, with Kevin Carney as the mastermind. The facade of the scheme began to crumble when investors, emboldened by the promise of lucrative returns, sought to cash out their investments. It was at that moment that the true extent of Carney's deception began to unravel. Instead of honoring his commitments and delivering on his promises of grand returns earned as profits, he resorted to a familiar tactic, robbing Peter to pay Paul. In essence, Carney's scheme operated as a Ponzi, where funds from new investors were used to pay redeeming investors. There was no separation of funds, no distinction between one investor's money and another's. It was a dangerous game of financial roulette, with Carney pulling the strings and his unwitting investors left to bear the consequences. To further complicate matters, Carney employed a variety of payment methods to disperse funds to investors. These methods included payment by check from his bank accounts with Washington Mutual Bank, NA, and JP Morgan Chase Bank NA, as well as cash payment. In some cases, he would simply retrieve stacks of cash from his drawers to pay investors whenever they showed up in his office to get their returns or recoup their principal investments. Carney's Ponzi scheme continued to flourish, fueled by the influx of new investors. Like many Ponzi schemes before it, Carney's operation relied on a constant stream of new investments to sustain its illusion of success. News of Carney's ability to turn out money at a high rate soon spread like wildfire, coupled with the fact that some third parties took notice of the lavish spending of some of the acclaimed successful investors, some of whom bought expensive items while others took expensive vacations. As the words got out about the ostentatious display of wealth by investors, the scope of the scheme increased exponentially, drawing in more investors. One such investor drawn into the scheme was Craig Gutowski. He was introduced to Carney through intermediaries Christine Hart and Don Swanson. Enticed by the promise of substantial returns, Gutowski eagerly invested $90,000 with Carney. In fact, he claimed to be making at least $50,000 every month. Since he was experiencing financial gains, he decided to enlist the participation of friends and family members in Carney's scheme. He brought his friends Eli Sherashovich III and Paul Nicolau to invest with him. Paul also brought his father, Chris Nicolau, to Gutowski, who claimed he would account for their investments through his account with Carney. Ultimately, Gutowski withdrew $165,000 from Carney. By the time authorities discovered Carney's scheme, Gutowski's account balance had totaled $246,913.80, as claimed by authorities. He also went ahead to create a company named CMG for the purpose of investing money with Carney. While investing with Carney, Gutowski had acquired a Mercedes, a motorcycle, and a trailer, and rented an industrial building to store the trailer. All of these assets became tangible manifestations of what he considered helped him to achieve financial success, further helping the scheme to gain momentum as many investors joined the scheme. Unknown to Gutowski and countless others caught in Carney's trap, the trading software purportedly responsible for their substantial profits was nothing more than a sham designed to deceive and defraud unsuspecting investors. Bill Harmony shed light on how Carney's elaborate Ponzi scheme served as a complex interplay of human psychology and financial temptation. He suspected that people were drawn to Carney precisely because his promises were so incredible. Here's what he said. "We see those that simply don't know any better and truly believe that they're going to get this return. And then there are those who know, in their gut, that this thing is going to be worthless at some point. They see other people making money, and they just can't stand the idea of being left behind." Truly, there were spectrums of individuals within Carney's investors. Some, probably out of naivety or blind optimism, genuinely believed in the possibility of getting high returns propagated by Carney. That's the power of hope, and how alluring financial prosperity can be. Others, however, were caught in doubts and apprehensions. But despite being aware of the scheme's dubious nature, they still went ahead and participated in the investment. They were swayed by the fear of missing out on lucrative opportunities witnessed by their peers. With each passing day as the scheme expanded and the stakes grew, pressures intensified, casting doubt on Carney's scheme that promised financial prosperity. The influx of millions of dollars into the scheme only aggravated the situation, as it became impossible to further sustain the illusion of wealth. At its zenith, investors had poured a staggering $20.5 million into Carney's scheme, with 95% of that amount simply funneled back to earlier investors in a futile attempt to perpetuate the illusion of financial success. As the harsh reality that they have been played for fools began to dawn, the chorus of discontent grew louder, morphing into a number of legal claims and financial liabilities that threatened to consume both Carney and his investors. As the scheme unfolded fully, it became clear that the whole operation was predicted on deception. Carney had been running at a loss right from the beginning of the investment scheme, with no true assets to offset the mounting liabilities that threatened to drag him into insolvency. As Carney couldn't pay his debts and investors were faced with mounting losses and a deep sense of betrayal, they embarked on a quest for justice, pressing several claims against him to reclaim their lost investments. The claims, which ranged from demands for the return of their principal investment to allegations of fraud and misconduct, underscored the intense impact of Carney's deception at the lives of his unsuspecting victims. They must have realized their lives had been shattered by what appeared to them as a golden opportunity for financial transformation. It must have been tough for them because they lost a lot of money when they thought they were going to get rich. Then, on October 8, 2008, the Illinois Attorney General's office received alarming reports of Carney's unauthorized sale of securities, a blatant violation of state and federal securities laws. Recognizing the gravity of the situation, they swiftly swung into action. They first obtained a court order to freeze Carney's various accounts to avoid further financial malfeasance. In the wake of the legal crackdown, the Illinois Secretary of State also took proactive measures to further curtail Carney's activities. It issued a stern prohibition against his continued involvement in rendering investment advice or soliciting investments within the state. The immediate response of the Attorney General and the subsequent prohibition from the Secretary of State helped protect investors from further harm, thereby upholding the integrity of the financial markets. It also sent a clear signal that fraudulent schemes would not go unpunished. Following the initial indictment of Carney in DuPage County, the Illinois Attorney General pushed further charges against him in Cook County. Indictment number 10-CR-5591 mirrored the allegations outlined in the DuPage County indictment, bordering on alleged malfeasance and fraud. With each new legal development, the full extent of Carney's deception came into the spotlight, revealing a pattern of deceit that spanned multiple jurisdictions. For instance, in damning revelation, authorities uncovered evidence of his attempts to conceal his ill-gotten gains and obstruct justice. Through the transfer of property totaling $115,000, Carney sought to hinder, delay, and defraud his investors, perpetuating the fraud at the heart of his Ponzi scheme. As his investigators delved deeper into Carney's operations, they discovered that he amassed a staggering $17 million from unsuspecting victims between January 2007 and October 2008, luring them with promises of lucrative returns and financial security. However, after withdrawals and other transactions, investors were left with losses totaling a devastating $10 million. The effect of Carney's fraudulent scheme was immeasurable as it left countless lives in ruins. In a moment of accountability, Carney stood before Judge George J. Balakis in DuPage County Circuit Court and pleaded guilty to a litany of charges. Among them were theft by deception over $500,000, as well as charges of mail fraud, wire fraud, and securities fraud. His admission of guilt was a great step toward securing justice for his victims, even while they battle with the impact of financial ruin. Making the announcement of the indictment, Attorney General Lisa Madigan shed light on the nefarious deeds of the former Elk Grove Village resident. She detailed how Carney deceived his victims into joining a fraudulent investment management scheme, enticing them with a promise of astronomical monthly returns on their investments. According to Madigan, Carney used a personal trading account with E-Trade to con people he knew personally in Cook, DuPage, and Lake counties. He leveraged their trust to advance his fraudulent scheme. He then systematically expanded his network to encompass investors from 20 different states and the District of Columbia. In her address, Madigan minced no words in condemning Carney's actions. Mr. Carney's scheme promised big returns but instead only resulted in financial devastation for his victims. His criminal acts have forever altered their lives, she said. Subsequently, Jude Nicholas Ford sentenced the disgraced investment manager to 13 years in the Illinois Department of Corrections, or IDOC. Of those 13 years, 8 were allocated for the theft and financial exploitation of convictions, while an additional 5 years were imposed for the security fraud plea. The sentence was, to some extent, a suitable punishment for crimes that had left so many lives in ruins. But it didn't end there. The judge ordered that he pay $10.2 million in restitution to more than 300 victims who lost money in his criminal Ponzi scheme. Altogether, the sentence and fine imposition were a small measure of justice for investors whose financial futures were irrevocably altered by Carney's greed and deception. The obvious truth, however, is that it would be very difficult for the investors who had placed their trust and their savings in Carney's hands to recover fully from the financial setbacks and emotional turmoil. After all, the true cost of Carney's deception could not be measured in dollars and cents. Reacting to the judgment, Attorney General Madigan had this to say: "This is a fitting punishment for the fraudulent acts that Mr. Carney committed to enrich himself at the expense of clients who entrusted his word and alleged expertise." Earlier, investigators from the Illinois Secretary of State's office had investigated Carney's fraudulent activities before referring the case to Madigan's office for prosecution. Secretary of State Jesse White also shared Madigan's sentiments as he condemned financial fraud, describing it as a scourge that inflicts untold harm on innocent individuals. "Financial fraud hurts innocent people, and scammers like Carney need to know that they will be prosecuted and sent to jail," he said, adding that investors need to investigate before they invest and make sure that the person they invest with is properly registered. Apart from the 13-year sentence, Carney also served an 8-year prison sentence in the Jacksonville Correctional Center in a separate Cook County case, also handled by Madigan's office. The particular case involved a similar scam perpetrated on victims who invested with him after October 2008. According to Madigan, even after the Securities Department of the Secretary of State's office seized Carney's bank accounts and ordered him to cease business in October 2008, 4 additional consumers lost investment funds, totaling $110,000 in December 2008 and January 2009. In the preceding Cook County indictment, Carney pleaded guilty to theft, securities fraud, and financial exploitation of an elderly person. As a result, he was ordered to pay restitution of more than $1.3 million to his victims. The story of Kevin Carney's fraudulent exploits has been chronicled as an episode on the television show American Greed, aimed at cautioning individuals who participate in fake investments. And that brings us to the end of the story of the multi-million-dollar fraud perpetrated by Kevin Carney, with victims spread across various countries. We strongly advise that you stay vigilant in the financial world, so you don't fall into the mechanizations of fraudsters like Carney. If you found the story interesting, kindly like and share the video, and remember to subscribe for more videos.